Welcome to the Tech Egg. Don't get scrambled. Enjoy the video.
You start by locking down prerequisites: capital, time horizon, and a risk limit you will not break. Next, pick 3 complementary data sources: price, volume, plus 1 alternative, because diverse inputs reveal hidden patterns. Once done, translate your goal into objective metrics: an edge target like 1% per trade, a minimum win rate, and a maximum drawdown. Make sure to record everything. Without clear numbers, you cannot measure an edge, nor know when to iterate. You now create discipline tests, run backtests, but then forward test on unseen data to avoid overfitting. Use walk-forward validation so you assess stability over shifting regimes. This reveals whether performance persists. Once done, evaluate P/L, expectancy per trade, Sharp, and max drawdown. Also measure parameter sensitivity so you understand fragility. Make sure to keep experiments small, 50 to 200 trades, or a few months of paper trading, because rapid iteration exposes which signals matter and which are noise. You move to live implementation by scaling in. Start at 1/4 to 1/2 of planned capital so slippage and costs stay visible but contained. Automate execution with hard stop loss and kill switches, and log every trade so you can correlate behavior with market conditions. Once running, monitor key metrics in real time. If performance degrades, check for data drift, execution issues, or risk sizing errors, and then revert to the last proven configuration while you diagnose.
Thanks for watching. Consider subscribing if I helped unscramble your problems.